Right now, as you're watching this, shares of the trade desk are getting absolutely hammered. The stock closed at $17.67, already down almost 7% for the day, but then, before the market even opened the next morning, it crashed even further, down over 28% in pre-market trading, landing around $12.67. That is not a typo. A company can lose more than a quarter of its value before the opening bell even rings. So the question everyone wants answered is simple. What on earth is happening to the trade desk? And is this a broken company or a beaten-down bargain? Stick with me because the numbers tell a much stranger story than the headline crash suggests. Let's start with what the company actually does with its money, because this is where things get confusing fast. On paper, the trade desk looks incredibly profitable. Its gross margin, which is the percentage of revenue left after covering the direct cost of running its business, sits at almost 77%. That's an extremely high number, meaning for every dollar of sales, the company keeps 77 cents before other expenses. Its operating margin is a healthy 19.6%, and its profit margin is 13.6%. In the last 12 months, the company brought in almost $3 billion in revenue and turned that into just over $400 million in actual profit. Those are not the numbers of a company falling apart. So why is the stock collapsing? Here's where things get interesting. Look closer at the growth trend and a pattern starts to emerge that explains a lot. Back in 2021, revenue was growing at a blistering 43% per year. In 2022, that slowed to about 32%. In 2023, it slowed again to just over 23%. In 2024, it ticked back up slightly to 25.6%. But in 2025, growth dropped to 18.5%. And now, in the most recent 12 months, growth has fallen all the way down to just 11.6%. That's a company that used to grow like a rocket, gradually turning into a company growing like a normal, mature business. And that slowdown becomes even more dramatic when you look at earnings per share. In 2023, earnings per share growth was an explosive 227%. In 2024, it was still strong at 116%. In 2025, it dropped sharply to just 15%. And in the most recent 12 months, earnings per share growth has essentially flatlined at only about 1%. That's the real story hiding behind the crash. Investors aren't necessarily worried about today's profits, they're worried about tomorrow's growth engine sputtering. But here's where it gets genuinely puzzling. Because if you only looked at the valuation numbers, you'd think this stock was a screaming bargain, not a falling knife. The trailing price-to-earnings ratio, which tells you how much investors are paying for each dollar of past profit, is just under 21. That's fairly normal. But the forward price-to-earnings ratio, which uses expected future earnings, is under 9. That's remarkably cheap for a company with these kinds of margins. Even more interesting is the PEG ratio, which compares the stock's price to its earnings growth rate. A PEG ratio around 1 is often considered fair value, and anything meaningfully below 1 is often seen as cheap relative to growth. The trade desk's PEG ratio right now is just over half, about 0.53. At first glance, that sounds like the market is practically giving this stock away. However, one number changes the entire picture, and that number is trust. A low PEG ratio only means something if you believe the growth numbers behind it will actually hold up. And given how fast growth has been decelerating, the market seems to be saying it doesn't fully believe those forward estimates anymore. Now let's talk about the balance sheet, because this is where the trade desk actually looks quite strong, and it's a detail a lot of nervous investors might be overlooking in the panic. The company holds close to $1.5 billion in cash against just over $430 million in total debt. That gives it a net cash position of a little over $1 billion, or a little over $2 per share, money sitting in the bank after subtracting everything it owes. Its debt-to-equity ratio is just 0.17, meaning for every dollar of shareholder equity, the company only carries about 17 cents of debt. That's a very low-risk balance sheet. Its current ratio, which measures whether a company can cover its short-term bills with its short-term assets, is about 1.7, comfortably above the safety line of 1. This is not a company drowning in debt or scrambling for cash. If anything, it has plenty of breathing room, and that breathing room shows up in how efficiently the company turns money into more money. Return on equity, which measures how much profit is generated from shareholders' money, is about 15.5%. Return on invested capital, a broader measure of how well management uses all the capital at its disposal, is even stronger at almost 25%. For context, the company's weighted average cost of capital, essentially what it costs the business to raise money, is under 10% at about 9.5%. When your return on invested capital is more than double your cost of capital, that's usually a sign of genuinely efficient management. So we have a company that's shrinking its growth rate, yet still generating strong returns on the money it deploys. This is exactly the kind of contradiction that makes investors argue with each other in the comments section. Here's another detail most people scrolling past a stock chart would completely miss. Look at the share count. Shares outstanding have actually decreased by a little over 4% over the past year. That means the company has been buying back its own stock, which is why you'll see a buyback yield of about 4% and a shareholder yield, combining buybacks and any dividends at that same level. This is a company with no dividend at all, choosing instead to return cash to shareholders by reducing the number of shares in existence. Whether that's the right strategy during a stock crash is something reasonable people can disagree on, but it does tell you management believes in the long-term value of the business, even while the market is currently voting otherwise. Now let's address the elephant in the room, because you can't tell this story honestly without talking about the bears. Short interest, which represents investors betting the stock price will fall, sits at about 73.5 million shares. That's close to 16% of all outstanding shares betting against this company, and it would take about 4 days of average trading volume just to close out all those bets. That is a significant number of people positioned for more pain. At the same time, the stock's 50-day moving average is around $19, while its 200-day moving average is closer to $29, meaning the recent price trend has been sitting well below its longer-term trend for a while now, even before this latest crash. The 52-week price change tells the most brutal part of the story. The stock is down almost 80% over the past year. That's not a stumble. That's a near total collapse in market value over 12 months. And yet, even with all of that, Wall Street analysts covering this stock haven't thrown in the towel. The average price target across 36 analysts is about $24, which would represent roughly a 36% increase from current levels. Their consensus rating sits at hold, not a bullish buy, but also not a bearish sell. Analysts are also forecasting future revenue growth of a little under 9% annually over the next 3 years, and earnings per share growth of about 9% annually, numbers that suggest they expect the slowdown to stabilize rather than continue collapsing towards zero. So here's the question worth sitting with. Is the trade desk a maturing giant simply settling into slower, steadier growth? Or is this the beginning of something the market is only just starting to price in?